You have until April 15th to do something most people forget they can do. And if you're a high wage earner who's been maybe maxing out your 401k but ignoring your IRA, this window could be worth thousands of dollars to you and your family over your lifetime. Here's what nobody talks about.
This video is for educational purposes only. Always consult professionals before making legal, tax, and investment decisions.
Here's the situation. Every year you get a window from Jan 1 to April 15th, where you can still make an IRA contribution for the prior tax year. That means right now you can contribute for either 2025 or 2026.
Or both.
2 years, one window. Most people don't realize that there's that kind of flexibility.
And here's why this matters more than you think. The contribution limits themselves, which are $7,000 if you're 49 or younger, $8,000 if you're 50 or older. Now, the limits typically go up every year with inflation. In fact, next year they will. But those are just guardrails. They're not goals, and they're not really, they're just ceilings. The real question is, how do you use those limits as a tool to ultimately lower your family's lifetime income tax bill?
So let's talk about what we mean about lifetime tax bill. One of our core beliefs is that taxes are on sale right now. We're running record deficits, record debt, record interest payments. At some point, we really believe that the government is going to have to raise income tax rates. So the question becomes, do you want to pay taxes now while they're at historically low rates, or later when they could be significantly higher?
That's the real decision behind every IRA contribution. Traditional IRA, you get the deduction today, you defer the taxes, but you're going to pay them later at a rate the government selects. Like, we try to say that our clients' IRAs have a partner, and the partner's the government. The government is going to tell you his partnership interest in the year you decide to make the Roth conversions.
The IRA is an IOU to the IRS, essentially.
So what we think that rates are going to be higher at some point. So the question is, does a Roth IRA make sense? The Roth IRA, there's no deduction today. You put after-tax dollars in, but that money grows tax-free forever. And you'll never pay taxes on it again. In fact, that money under current law could grow for your beneficiaries for an additional decade. And if there's another tool that if your income is too high to put money in a Roth, there's this little talked about thing called the Backdoor Roth IRA.
So this is not a knee-jerk decision. It's not always do Roth or always do traditional. Depends on your income now and where you project your income to be in retirement. Your other accounts matter. Your spouse's situation matters. Remember, every family's income tax situation is completely different.
And I think that's an important point. What might make sense for you may not make sense for your brother or sister, or your neighbor, or your cousin. It is snowflake different between, person A's tax situation and person B's tax situation.
So true. So your planning requires a real conversation looking at it from multiple angles.
So here's something that surprises a lot of people. You don't have to fund your IRA from your paycheck or your bank account. You can fund it with, say, your investment portfolio. Sometimes even parents gifting. If you would receive a gift from a parent or an aunt or uncle, it's also money that you could use to fund a Roth IRA or an IRA.
Let me explain. So you don't have $8,000 sitting in cash, but you do have a brokerage account with investments that have been growing. We can sell some of those holdings strategically, maybe even taking a tax loss, and use that money to fund your IRA contribution. Sometimes that even makes more sense than using cash, because we can choose which lots to sell, manage the gains, and coordinate it with the rest of your tax picture.
The point is, I don't have to have the cash flow isn't always a reason to skip the contribution. Sometimes there are ways to work around it. You just need someone thinking about the entire picture, which is the difficult part.
So we see some mistakes. Mistake number one, assuming pension income counts as earned income.
Right. So if we need earned income to put money into an IRA or Roth IRA, let's talk about what trips people up every year. So to be clear, to contribute to an IRA, you need earned income. That's W-2 income, self-employment income, compensation for work. It doesn't count pension income. It doesn't count Social Security. It doesn't count investment income. So if you're retired with no earned income, you can't contribute to an IRA or a Roth IRA even if you want to.
We see people discover this in March or April, right when they're filing, and realize they can't do what they thought they could do. That's a frustrating conversation to have. And it's avoidable with a little planning.
And if this is kind of planning you want more of, not the flashy stuff, just questions that actually matter, hit subscribe. We put out new videos each and every week.
Mistake number 2, not coordinating your IRA decision with the rest of your tax plan.
So here's what we mean. Let's say you're doing Roth conversions. You're deliberately taking money out of your IRA, paying taxes on it, and moving it to a Roth. It's called a conversion. The hope would be that you're avoiding higher taxes later. We think for a lot of people it's a sound strategy. And if that's your strategy, does it also then make sense to be adding more money to a traditional IRA or traditional 401k? You're just putting money right back into the bucket that you're trying to empty. So perhaps Roth contributions make sense as well.
A lot of our clients are very charitably inclined. You're over 70 and a half, and you could be doing qualified charitable distributions, or as we call them, QCDs. A QCD is simply giving money directly from your IRA to your favorite charities using pre-tax dollars. It's the same as getting a deduction for your gift, while also counting for your RMD. That changes the math on whether you should be managing the taxes on your IRAs in the first place.
It goes to our charitable giving strategy. It's a really wonderful strategy for people to employ once you're old enough. So if we look at tax planning, every decision connects to every other decision. That's why managing it all requires real conversations, not just checking boxes.
The third mistake is waiting till the deadline and rushing the decision.
Yeah, the window between January 1st and April 15th is a gift. It gives you flexibility. Sometimes they're business owners with uneven income. They don't know how much real cash flow they're going to have. It gives them time to wait until April 15 to see what their situation looked like. Sometimes their family's navigating transitions. Might be a job change, might be a spouse going back to work, or even retirement. It allows you the flexibility to take your time.
So that flexibility becomes a trap if you wait until the last minute and panic. The best approach is to have the conversation early, figure out if it makes sense, how much to contribute, and whether it's traditional, Roth, or even backdoor, and then when to execute with time was to spare.
So think about it. The worst outcome isn't contributing to the wrong type of IRA. The worst outcome is missing the window entirely and giving up the opportunity for another year. Once we miss it, it's lost and gone forever. There's no going back.
So let's bring it back. The IRA contribution window is open right now. You have until April 15th to contribute for 2025, but you also can start for 2026.
So again, the limits are $7,000 if you're 49 or younger, $8,000 if you're 50 or older. Limits are a little bit higher for 2026, but the limits aren't the point. The point is that using this tool strategically is part of a bigger plan to lower your family's lifetime income tax bill. That's where it's at. And even if we have clients with millions and millions of dollars who put this money in every year, because if you think about it over a decade, a husband and wife could add $80,000 each. That's $160,000 plus hopefully some growth. I mean, these are meaningful dollars that you can use over an extended period of time.
So traditional or Roth, cash or portfolio, this year or last year. These aren't decisions to make in isolation. They're conversation to have with someone that sees the whole picture.
And if you're thinking, okay, but how does this fit into my bigger picture? Watch this video next. We'll show you how smart families think about their lifetime income tax bill, not just this year's income tax bill. And keep in mind that the accountants often think about just this tax year. So we'll talk about the strategy that could save you thousands and thousands of dollars over the next couple of decades.
So if you'd rather talk through your specific situation, figure out whether traditional or Roth makes sense for you and how it all connects, click the link below and schedule a conversation. No pressure, just a chance to look at the whole picture together. Because as we say, investing is the easy part. It's the tax planning that most people miss.